What's up? All right, so I've seen people drawing the nuttiest looking Elliott waves all over this stock market crash, and I want to clear things up a little bit. The waves are not that crazy. The majority of the waves are just simple impulse waves and simple corrective waves. And this is Brian Lewis with MMT Investing, and things just changed. So I want to look at the Ray Dalio credit cycle inside of a credit cycle thing, because we have that going on for sure. And also the comparison of this to the Nikkei bubble is really good, because the Nikkei bubble, we saw all of these double tops. We saw double tops all over the Nikkei like this. Underneath big support levels, there's doubles, doubles, doubles. And that is a big thing. And we have the same type of support levels. If you see my Japanification 3 video, like all three of these support lines completely work in the Nikkei model. And the tangent lines that split the waves work in the Nikkei model. And just to jump here into the Elliott waves, Elliott always taps that like button right now to help me out with the YouTube algorithm. So the big obvious Elliott wave here, and I'm going to use these bull trap lines that we have set up here to model this, and it is an A, B, C corrective wave. And this one I have seen people point out quite a bit. I've seen people make a mess out of this as well, but this is a pretty clean ABC. And here, this, I don't think I've ever seen anyone clean this up or make sense out of this. And what we have here is a bunch of double top reversals. We have a double, a double, a double, a double, a double. And it's pretty clear that we get a 1, 2, 3, 4, 5 impulse wave here, and that's right along a higher level. Well, let's go dig in. So see this green bull trap line here, that's the B, A, B, C, is also a 1, 2, 3, 4, 5 impulse wave. So the B here is an impulse wave, and then the B here of a larger scale, A, B, C, corrective wave, is this 1, 2, 3, 4, 5 impulse. So you get the 1, 2, 3, 4, 5 here on this scale of the Ray Dalio kind of weekly level cycle, and the 1, 2, 3, 4, 5 impulse here on this bull trap of the sort of monthly level cycle. And we'll zoom out in a second. And then if you like this crazy mess of stuff here that I haven't seen anybody even attempt to do this correctly, they're just like, yeah, whatever. I mean, this is on the same scale as this 1, 2, 3, 4, 5 impulse. This is just a 1, 2, 3, or sorry, ABC, and then it's the 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. It's the corrective pattern. It's the ABC corrective pattern here, and then we reverse into a 5 wave over here. So I can't really dig into the daily time scale because it's too small and crazy, but I can easily go out and repeat these patterns on the higher level here. And let's do that. So here we get a bigger ABC corrective wave, and we have our 1, 2, 3, 4, 5 bull trap on this. And if we repeat the same kind of ABC and then the corrective pattern that we get down here, it's breaking the line, back testing it, and it's right along this line, so that would just go like here, A, B, C, and then you'd get that 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3 consolidation pattern. And then we can zoom out even farther and get the main wave that cuts this entire ABC, and you can do, and I think the length of this might be a bit off, but just for example here, you get the A, and then you get a B wave out to this, and then a C. And that C is the long-term bear market that would follow this pattern. And this is the reversal point into the positive credit expansion phase. So this whole thing here is our 3 to 4 month credit contraction cycle that I've been talking about in almost every video. And it has kind of the bouncing pattern. And this is what that pattern is. And this one is pretty ugly and it doesn't land where I was kind of aiming. But let's try that one again. A, B, C. I guess it would need to come down here. A, B, C, right? And then you get the 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3 consolidation like that. And then you would get the same kind of repeat here as this 1, 2, 3, 4, 5 impulse on the B part here. So you get your 1, 2, 3, 4, 5, and those 3, 4, 5 on the impulse, that is our double tops that we keep seeing on the Nikkei. It's the 3, 4, 5 is the double top. A 3, 4, 5 is the double top. That's the Nikkei double top that we keep getting underneath these consolidation areas. And then I guess if you want to play around a little bit more with it, if you get in here on the smaller time scale in the middle of these waves, you get these dead cats and you get these back tests, and these are just it's just an ABC here, ABC. It's just a 3-wave kind of corrective pattern in the middle of a down movement on that scale. That's like a tinier one inside of those. And that is the Ray Dalio Elliott Wave Analysis that covers everything in our current and then expands it out even 2 more levels to the entire backside of the bubble bear market pattern. If that pattern does continue, and I've been trying to track these tangents and figure out what's going on, and that double tops on the Nikkei really made me see the reversal patterns that are getting underneath these lines. And then and then I saw an Elliott Wave video that did like this kind of C wave here, and I went, okay, I see what's going on. And then the Elliott waves are not that crazy, except for this one consolidation pattern that we get at the bottom here is weird, and it's cool. It's pretty cool. I've been doing those consolidation zones on this area, and that's what that is. It's just the Elliott corrective pattern on a C wave. So that is, I guess so. Please hit the like button to help me out with the YouTube algorithm. This is not financial advice or trading advice. This is just a model, and I'm just trying to kind of track the backside of this bubble. and I've seen people try to draw Elliott waves on this blow off top on the way up, and it is just so funny. They're just like, it's like an A, B, C, and 1, 2, 3. And it's just like this huge mess. It makes no sense. It's really funny. But when you get into this credit contraction pattern, the waves really pop out where you can see them. And we have examples of this from like 2018 also, where the waves are just really cleaned up and you can really see them. So I mean, that's kind of what I started this channel based on, is just being able to see these wave patterns. But I didn't even know what Elliott waves were when I started modeling this thing. I was just thinking about mathematical derivative graphs and tangent lines like we used to do in calculus. And I was like, this looks like wave charts that we used to do in school, and I started playing around with it. So it's come a long way, and I think we're at a good spot here. We're bringing in a bunch of theories that all work together, and we have these super long-term trend lines that go back to 2018, back to the 2008 financial crisis, go back to the very bottom of the everything bubble here, the Volcker bottom. So as soon as we break and backtest Volmageddon, we get off the blow off top, and then we break and we backtest financial crisis. And then when we break and backtest this Volcker, that really sets up the bear market. If that happens, then we have the longer term bear market set up, and that is we don't have much of a C wave out here. But yeah, that's this C wave here is just and it won't be that steep either. It's going to be a pretty slow and long bear market, and I don't know how much it would come down over time, but I showed you looking at several different bubble pop-offs. Like the Great Depression came all the way down from the top in just 3 years vertically, and that one was crazy. And then we saw in the Nikkei bubble, it took 20 years to get back down to the bottom of the bear. So that's kind of the time range for the backside of a bubble. It could be three, I guess. I don't know. I'm talking about like central banks and whether or not you can switch into a new monetary system, and how like the reason the bubble pops is because the thing backing your monetary system has lost its ability to back. Like you've printed too many currency units relative to the backing. And here on the everything bubble, our backing is oil, which has already tanked, no pun intended, and corporate collateral and real estate collateral, like the mortgage-backed securities and corporate bonds and stuff like that. But now everything, oil and all the securities, everything backing the dollar now is now junk status, and we're getting this crash and we're getting credit contraction, and that's what all this is. It's just the monetary expansion is just kind of reeling back in, and we're getting the credit contraction cycles here off the backside. So this is the beginning of the model, and then the bear market, man, it's hard to predict. If it gets set up like this, and we do set up the bear market, then it could be maybe this size of a bubble, maybe 3 or 4 years if it looks like the Great Depression, like steep, or it could be 30 years if it's an extended looking version of the Nikkei. So that's kind of the C wave is is questionable, but this pattern we have happening pretty well so far, and we'll see if this model holds up. So thank you and happy trading.